Aberdeen, or either way. The coverage looks a bit thin. This article was written by Steven Bavaria. Summary: closed-end funds offer unique advantages, like buying at discounts and leveraging with institutionally priced debt, making them ideal income-generating vehicles. Cash distributions are key contributors to total return, but it is essential to be sure they are actually covered by fund earnings. Some investors overly prioritize distribution yields, neglecting the importance of considering total return as a whole. Aberdeen, aka funds often seem to push the envelope regarding paying out more than they actually earn. When I first introduced the income factory here on Seeking Alpha, I was called a heretic. Now, thousands of my readers describe how they sleep better at night through market downturns. The idea that we could generate equity returns with less of the volatility and stress that keeps many investors awake at night by replacing typical growth stocks with credit and similar high-yielding investments was considered a pretty radical idea when I first suggested it a decade or so ago here on Seeking Alpha. Creating our own growth via reinvesting and compounding high cash distributions was how I often described it. Now, of course, thousands of readers and followers have come to accept the idea that math is math and total return is total return, regardless of whether it is earned via cash dividends or capital gains or losses. Once investors came to realize the possibilities inherent in high-yield investing, many of them also learned to appreciate closed-end funds, CEFs, for their unique advantages as vehicles for holding high-income-producing asset classes. I have called it the alchemy of closed-end funds. The features that allow CEFs to hold asset classes whose natural yield may be 7 or 8% and use those cash flows to fund distributions of 9 or 10% as a result of investing. Buying the funds at discounts, often as much as 10% off the actual net asset value of the funds, resulting in our having more assets working for us and generating income than we actually paid for. And being able to leverage our investment with institutionally priced and managed debt at prices and terms unavailable to the average retail investor. As more and more investors have come to realize the value of income investing in general and the unique advantages of closed-end funds in doing so, there has also been more and more attention paid to cash distributions as a key contributor, perhaps the key contributor, to total return, even to the point where some investors seem to look at distribution yields as all that matters in judging a fund, rather than considering total return as a whole. Like any too much of a good thing, focusing exclusively on cash distributions without keeping an eye on the overall total return can be dangerous. Some funds, apparently knowing there are some investors who are totally enamored by high distributions, may deliberately pay out more cash than they are actually earning, which means the investors are collecting big cash payouts, but at the expense of the funds actually eroding their capital, eating their seed corn. In order to pay those big distributions, a simplified example would be a fund that owns $100,000 in bonds that pay an interest rate of 10%. The fund collects $10,000 per year in interest, which means it could pay out a 10% distribution and not erode its capital. In other words, it would start the next year with the same $100,000 as the previous year and could do that continuously, year after year, as long as the bond portfolio continues to pay its regular interest payments. But suppose the fund decided to pay out an 11% distribution one year, or $11,000. That would be 1% or $1,000 more than it collected in interest that year. So it would erode its capital by $1,000. So the following year, it would only have $99,000 to invest in the 10% bonds that it held, and its annual income would only be $9,900. At the end of the year, it might decide to keep its payout at $11,000, which would mean eroding its capital by the difference between $11,000 and $9,900, or $100, an even bigger erosion than the previous year. Each year, the fund paid out more than it actually earned, the more it would erode its capital, unless there were some offsetting capital gains to make up the difference. In our example above, if the fund that earned $10,000 in interest and paid out $11,000 in distributions had no offsetting capital gains, i.e., if its capital had not otherwise grown in value, then its total return to shareholders calculation would be total return $11,000, i.e., its distribution minus $1,000, i.e., its erosion in capital value equals $10,000 in total return. An investor who owned this fund and saw what was happening could easily maintain their capital investment going forward by reinvesting the $1,000 of unearned distribution that they had received. If they were an investor in their accumulative stage, e.g., a 35-year-old investing in a retirement fund with a 30-year horizon, they would likely reinvest the entire 11%, either in the same fund or in other assets. But either way, they should be aware that they are only reinvesting 10% of real earnings, and 1% is merely refilling the hole created by the fund being overly aggressive in its payout. This is a very mild example since the overpayment is modest, and most of us would be quite happy to achieve a 10% annual total return on the assets in our portfolio. A 10% total return would match or beat the average annual equity total return for the past century. And for the average investor planning to retire, it would represent a rate at which your investment portfolio would double and redouble about every 7 years, which mounts up substantially over several decades. Mind the gap. It's where the gap between the total return and the distribution rate becomes more extreme that investors have to be more careful, since that gap, the amount by which the distribution exceeds the total return, represents the amount of erosion in capital value created by paying out the excess, unearned distribution. Many closed-end funds will fail to earn the amount of their distribution from time to time. This is particularly true of equity funds, which collect very little of their distributions in the form of cash dividends, since the average S&P 500 stock only pays a yield of 1.5%. and have to rely on capital gains for 80% or more of their total returns. Since capital gains are often inconsistent and even volatile, many closed-end funds have what they call managed distributions, where they smooth out the volatility over time by essentially borrowing the gains from some months, i.e., future months, to pay this month's distribution, even if they haven't fully earned it yet. This sort of smoothing is okay as long as the bridge between profitable months is not so long that the capital erosion becomes too frequent or continuous. In the past, I have called out particular funds for being serial overpayers when it comes to consistently distributing more in dividends than they earned in income. One of them was MFS Intermediate Income Fund, MIN, which I described back in 2021 as the poster child for distributing more than you earn. In checking it today, I see that it still yields over 8%, but has only earned a total return of about 5% over the past year and an annual rate of 3% over the past 10 years, which accounts for MIN's consistent drop in market value and net asset value over its 37-year life. But closer to home, so to speak, there are other examples. Right in my own portfolio, until recently, was a fund called Aberdeen Credit Strategies, ACP. I had owned it many years earlier, sold it, and found it in my portfolio once again more recently when it acquired another fund I owned called First Trust High Income, FSD. Aberdeen's official name, along with other formerly Aberdeen funds, is now ABN, but this writer and lover of words and literature can't bring myself to try to pronounce it or use it. Why would a company with a great name and history, Aberdeen, choose to junk it and rebrand itself Aberdeen? Apparently, lots of others in the marketplace have asked the same question, as the rebrand has gone down in the annals of bad marketing decisions with the likes of New Coke, etc. But besides its weird name, ACP has also had a long history of overpaying while under-earning its distribution. It currently pays a distribution yield of 15.6%, while only earning a total return of 4.9% over the past year, a gap of over 10%. If we consider its total return on its net asset value, NAV, the coverage is a bit better, with a yield on NAV of 14.7% versus a total return on NAV of almost 7.9%, therefore a gap of 6.8%. Taking a longer view, the coverage is worse, with the current gap between ACP's current distribution rates and its 5-year average total returns on both market price and on NAV, both being around 13%. This chart from CF Connect shows what sort of erosive effect this sort of coverage gap has had on ACP's market price and NAV over time. ACP's management made a heroic effort to hold its distribution rate up in recent years, but there is no way to ignore the inevitable, so it finally dropped it by 22% last month. But even with the cut, it is still far from being covered, so I chose to sell out and remove it from our income factory model portfolio. All in the family. But that wasn't the end of it. As part of checking out ACP, I looked at the overall roster of Aberdeen, aka ABEN funds, per CEF Connect, and found out that overpaying its distributions seemed to be an Aberdeen family trait. This shows that ACP is not all that rare a case among Aberdeen funds in terms of having a distribution that seems to have been unsupported by its total return. Over the past year, Aberdeen funds' average gap between their total return on market price and their current distribution rate on market price is a gap of 3.6%. But ACP is third from the top with a gap of 10.7%, exceeded only by IFN and FACS with gaps 14.7% and 10.9%, respectively. Measured on its gap in NAV total return versus its distribution rate on NAV, ACP's gap of only 6.8% is slightly above the Aberdeen Funds Group average, which is a negative gap of 6.7%. This shows not so much a better performance by ACP as it does a pretty poor overall performance by the Aberdeen funds in general. When we look out at the Aberdeen Fund's 5-year gap between total returns, both market price and NAV, and their respective distribution rates, we see the same rather unimpressive story. Overall, the average annual gap between the group's market value total return for 5 years and its current market value distribution yield is 8.1%. For its average annual NAV total returns and distribution yields over 5 years, it is 9.1%. Based on that, one would expect to see a lot of both price and NAV deterioration over the past 5 years on many of these Aberdeen funds. And if you spot check many of the larger gaps besides ACP, like FCO, AWP, FACS, HQH, AEF, etc., that's what you'll see. I am not suggesting that this is a detailed analysis of individual funds. In fact, I own a few, including HQL and HQH, which I bought back when they were managed by a different fund manager before being more recently taken over by Aberdeen, as well as ASGI. I continue to hold all three because of their better performance over the past year on a market price basis. Total returns of 11%, 10.1%, and 10.2%, respectively. Plus the fact that the activist group Saba has taken a large position in each, probably because of their big discounts. But the apparent policy of Aberdeen to manage so many of its funds in a manner where they seem to consistently pay out overly large distributions that are unsupported by the underlying fund earnings makes me somewhat wary of the group as a whole. Often I am willing to give particular funds the benefit of the doubt if they are overpaying their earnings, but express their intention of making it just a short-term practice and are run by management firms with excellent records and reputations. For me, the jury is still out on whether Aberdeen merits that level of confidence.